Hey everybody, welcome back to the channel. We are back on another episode of the Daily Recap, episode number 2 after a 5-month hiatus. I just want to thank everyone who showed some support on episode number 1 yesterday. Super grateful and happy that a lot of people enjoy the format. And we're going to try to do it every single day, Monday through Thursday, 15-20 minutes, and get all the news that's important for the stock market every single day so that it's an easy way to consume it for everybody. Got a lot of stuff to talk about today. We got Jay Powell. We got trade representative Jameson Greer. We had the S&P 500 go down 1.5%. We got a complete reversal. We've got more news in AI. A lot to talk about. Let's get into it. Okay, so the first thing we'll talk about is trade representative Jameson Greer. I stayed extra long on my market open just to be able to hear his comments because I had a feeling, and I think the entire market had a feeling, that whatever he was going to say was going to matter. Now, why does this matter? Well, this morning, if you looked at your portfolio, in fact, I looked at mine at 4 a.m. this morning, and it was down a lot of money. Let me know in the comments who actually wakes up in the middle of the night and checks their portfolio. It's such a stupid thing to do, but like we all do it, even though there's like barely any volume and the pre-markets don't always matter. And nonetheless, and then I ironically had some pretty bad dreams after seeing how much money I was down. But look, in the morning, it was pretty bad. In the market open, it was pretty bad. And then Jameson Greer, who is the trade representative for the United States, he had some things to say. Now, what happened in the morning? China basically came out with a statement. Essentially, if you were to paraphrase it, they continued to escalate the problem with rare earth metals. And we thought that issue was dealt with on Sunday when Trump said, hey, don't worry about China. Xi had a bad moment. We're going to be okay. But then based on what they said in the morning, it felt like it was escalating. Market went down 1.5%. Then one of the head representatives that negotiates with China, with Scott Bessent, he said these following things. Number one, the United States and China had staff-level talks in Washington today, aka they are negotiating. There is an open line of communication. Number two, everybody needs rare earths. China knows this. They are really hurting themselves by acting like this. Number three, the Chinese realized they overstepped, which is why they pulled back some of their statements over the weekend. Number four, 100% tariffs are still on the table based on what China does next. And number five, we always watch the stock market and bond market, want to make sure the market responds to appropriate info. By the way, that 10-year treasury in the U.S. bond market is starting to come down. It's at 4.019. If that comes below 4%, that would not be the worst thing in the world. So why do the markets do an entire U-turn? If you bought the dip from around 9:30 a.m. Eastern to about 9:45, those were the 15 minutes where you really had an opportunity where the market kind of took a hit. Why did it do a U-turn? Well, in my opinion, Jameson Greer basically told the market, we are not trying to escalate the situation. We did not initiate the escalation of the situation. We want to work with China. It's just we were dumbfounded last week when we were getting all these notices by other countries that are now being threatened by China's new quote-unquote export controls. China says they're not export controls. The United States says they're obviously export controls. And that is hurting the supply chain and flow of rare earth metals and minerals. As a result, the markets basically were like, okay, cool. So Trump is not trying to start some crazy trade war. Trump did not out of the blue say, hey, let's like mess with China, which is kind of the, I guess, the perception the market had back in April, which is why markets took a 30% drawdown. And we had a 3% drawdown on Friday because I think the markets were just like, dude, we don't want to deal with this again when Trump starts random trade wars. I think Jameson Greer basically came out and said, it's not really our fault. We want to work with the Chinese. They want to work with us. In fact, on Friday, their foreign ministry, or on Saturday, last week, came out with a bunch of statements trying to de-escalate. And then JD Vance de-escalated, Bessent de-escalated, Trump literally de-escalated. But then this morning, they escalated again. And we are trying to de-escalate. So that doesn't mean there's a conclusion on this China saga. But I think the reason the markets literally went and did a V-shape is because there is more clarity on what's happening, likely when it's going to end, which, you know, Trump and Xi, they confirmed they're going to be talking next week in South Korea. And so at the APAC meeting, there likely is going to be some level of communication to be able to resolve this. And if it does, that could be a tailwind for the broader markets. But I think we got some clarity today, even if we're not out of the woods. And as a result, that's why the markets were able to U-turn. All right, next topic on the day, Jay Powell. So not only did Jameson Greer say some things today, our boy Jay Powell said a couple of things. And let's just say he said the same things that you would expect him to say. But I almost think the market needs him to say these things over and over again for them to feel happy. So on my market open, we didn't watch Jay Powell live. I predicted Jay Powell's going to say, labor market's weak. We're going to have more rate cuts. Jay Powell said, in a nutshell, labor market's weak, we're going to get more rate cuts. Or the labor market weakness is signaling that we will have more rate cuts. He didn't literally say we're going to have more rate cuts, but he said you're likely going to have some rate cuts. And so as a result, he didn't literally say we're going to have rate cuts, but he basically signaled that we're going to have rate cuts. So as a result, that was another reason why the markets got excited. They were like, all right, so Jay Powell is definitely on board with the rate cut thesis. Jay Powell understands the risks to the labor market from a low hiring economy, along with AI potentially commoditizing jobs. We've been talking about that a lot on the channel. What's going to happen to a lot of these different jobs, blue collar and white collar jobs in the world of AI. And so you probably want to have rates low to at least be able to get ready to cushion the impact if there is more significant job loss. And then if we're going to get rate cuts, the market is able to price that in. Now, two other things he said that I think were really important. Number one, he said, the data is showing that the economy is largely where it was in September. Now, we don't have a lot of data because of the government shutdown. By the way, Kalshi's estimating that government shutdown has a 30% chance to last until November 16th. So that might be a little bit longer than expected. But Jay Powell did say the data before the shutdown suggests that growth may be better than expected, largely where it was in September. So this was really bullish because if you have the labor market weakening, which indicates a reason to cut rates, right? Because if jobs go down, you want to be able to have that cushion for the labor market with rate cuts, and growth is not deaccelerating, which would hurt earnings and hurt the broader economy if growth is going down, then I mean, you've got a scenario where assets are able to benefit from rate cuts, but also growth doesn't have to slow down, which is good for the earnings on those assets. The final thing Jay Powell said, which was the most important thing that he made in terms of the statements, is the central bank of the United States is nearing a point where it will stop reducing the size of its bond holdings, but gave no long run indication of where interest rates are ultimately headed. Essentially, the TLDR on that is that they're going to stop quantitative tightening. So when they are dumping bonds, that is quantitative tightening. That is reducing the size of the balance sheet, and that is entering less liquidity into the system because obviously you're tightening the overall balance sheet in general. Quantitative easing, QE, and Jay Powell was such a QT, in my opinion, for telling us that he's ready to engage in QE again, is what we had in 2020 when the Fed started buying up bonds, and as a result, you have more liquidity, lower rates. That is basically the scenario for getting asset prices to go up. Does that result in a bubble? Maybe. We'll worry about that when that happens. But the point is, today, the market simply needed a signal on, hey, are we going to stop the contraction of the U.S. balance sheet? And Jay Powell basically said that's coming to an end by the end of the year. Now, we don't know if that's for sure going to happen, but that was the perception of what the market took away from his comments. And as a result, stocks went higher. So pretty wild 1.5% swing to the downside. If you bought the dip on anything at that time, you probably did well. And now, at the time of recording this, we're up about 0.5% based on what Greer said and based on what Jay Powell said. All right, next up, we've got bank earnings. The banks crushed it. The banks absolutely crushed it, folks. So the main banks that we had today, and the reason the banks matter, even if you are not invested in banks, is because they are the financial ecosystem of the United States. If the financial structure of the U.S. is strong, loans are being dispersed, credit loss provisions aren't that bad, delinquencies aren't that bad, capital spending is strong, M&A is strong, IPOs, underwriting of different forms of credit are not at a horrible level, then that means the rest of the economy, aka big tech, which largely relies on financials. I mean, obviously the big tech balance sheets don't literally need loans and access to the capital debt markets, but it is good to make sure that the capital debt markets are in the right shape if those are needed. And you got a lot of other tech companies that are not as big as Amazon that do need access to loans and banking. And the banks need to be in the right position. JP Morgan beat on the top and the bottom. BlackRock beat on the top and the bottom. Citi beat on the top and the bottom. Goldman Sachs beat on the top and the bottom. And Wells Fargo had a massive beat on the top and the bottom. Wells Fargo up 7% on the day. The rest of those relatively flat to red. I mean, a lot of those stocks are up 20 to 30%. So, they don't have to go up just because they have good earnings. But nonetheless, all those stocks or all those companies had phenomenal earnings, and eventually their stocks will potentially reflect that. I think the most important thing from the bank earnings is some of the quotes that we got from some of these CEOs. So Larry Fink basically said there's about $4.5 trillion of essentially financial assets that are already tokenized in the context of stocks, stable coins, his ambitions to turn that into real estate, et cetera. So you've got some pretty good, essentially, prerogatives from Larry Fink on the idea that if tokenization is already happening and $4.5 trillion out of the $13.5 trillion of assets they have is related to crypto, tokenized assets, et cetera, then you're likely going to get a pathway for those to increase, which is bullish for Robinhood, Coinbase, Kraken, all the companies that deal with the tokenized ecosystem. And then Larry Fink specifically said the value is held in digital wallets, and we expect it to expand rapidly across crypto, stablecoins, and tokenized assets. So that's the first thing. And then the second thing he said, which is really important as well, is about data centers. So we know that BlackRock, yesterday, JP Morgan announced a $1.5 trillion initiative to increase energy, data centers, and like 10 different other sectors, but energy and data centers are two of the most important things that they're going to be investing over the next 10 years into the United States because they are recognizing the demand for energy. You had BlackRock's Larry Fink once again say on the earnings call that data centers are a massive priority and that we are going to make sure that data centers continue to succeed. An estimated 1.5 trillion of capital is going to be needed in the next 5 years in just the core and shell of data centers, and that's not including the chips. The growth of cloud computing and AI are propelling this capital demand, and BlackRock is well positioned to expand our leadership. Teams across BlackRock are exploring how AI can play a bigger role in making sure that markets are more accessible and efficient. Essentially, Larry Fink is telling you that data centers are a massive opportunity for financial institutions. They are heavily incentivized to make sure that the financing for those data centers are possible. And as a result, you've got the banks that pretty much crushed earnings. And it looks like tokenization and data centers are going to be the key focus of a lot of these financial institutions over the next decade. Okay, let's talk about some stats. So I saw one stat today, and I was pretty surprised, but also not surprised at this stat. And it's quite incredible when you put it into some perspective. So take a listen to this. On Friday, when we had the 3% drawdown, the worst drawdown that we've had since April, well, the market went up, the market went down. I mean, it was a pretty crazy day. And in the midst of the market going up and down, obviously it was very volatile. So traders traded within the volatility. The total US option volume hit a record high 108 million contracts that were traded on Friday. To put it into perspective, in 2021, the highest amount of volume, puts and calls together in the options market, was 60 million. And that was at the peak of what was happening in 2021. So this was almost double the amount of volume from 4 years ago. And 2021 was a pretty crazy time. Again, I don't think we're in 2021. We've talked about that a lot on the channel, why there's some unique, fundamentally differentiated aspects towards how we can conceptualize what was happening in 2021 versus now. Rate cuts, earnings, AI, there's a lot of different variables to it. But yes, there is some froth in the market, and some of that froth is going to be there. And when that froth is there, you're going to get record option volumes like this. You're also going to get a lot of people that want to hedge to the downside if you're getting a 3% drawdown. 61 million calls were traded on Friday, 47 million puts. The puts were the second largest on record. The calls were an all-time high, and this also beat April's Liberation Day trading activity when 100 million options were traded in one day. Super bullish Robinhood, super bullish Webull, super bullish Fidelity, Schwab, all these brokerages benefit from the volatility of going up and down. But the point is, we are in a massive generation of investors that, from my perspective, whether it's retail or institutional, are either ready to buy the dip, number one. Another stat for you guys is that NVDU, the 2x leverage NVIDIA fund, picked up 130 million of inflows on Friday. So NVIDIA went down 5% and people piled into leveraged NVIDIA, which is quite incredible. We're going to get more stats over the coming days on how much of the dip was actually bought on Friday by retail. The three stocks that were bought the most were Meta, NVIDIA, and Hood, as per JP Morgan. So that came out yesterday as well. But we are in this opportunity for a generation of investors that see every market drawdown as a reason to get more excited. I mean, even I bought some more calls on my SMCI position. I have the 60-90 call debit spread for January 2027 because I was like, well, it came down. It should probably DCA down into these calls. And so I think all of us have this mentality that the future is bright. There's a lot of growth. There's a lot of optimism. There's a lot of excitement. There's a lot of opportunity that exists. And when you get an opportunity for a drawdown, or when you see a drawdown, it is perceived as an opportunity. And that's just the generation we are in. And I don't think it's just a buy the dip generation of retail. I think it's a buy the dip generation of institutional investors that realize they're not going to get the amazing prices they were going to get 4, 5, 10 years ago when you had a drawdown, because that drawdown is easily eaten up. And 108 million contracts traded in one day because of a tweet from Trump about China causing a 3% drawdown is quite remarkable. So I think the takeaway for investors here, and let me know in the chat if you loaded up on call options or put options, or sold calls, sold puts during that Friday, is that people are ready to take advantage of the opportunity if the opportunity is presented. And the final thing on this is that there are still $7.5 trillion on the sidelines getting 3.5% from money market funds. When that 3.5% becomes potentially 2.5%, by the way, Paul Tudor Jones came out today. He says he thinks the NASDAQ will significantly be higher by the end of the year. And he thinks by the end of next year, we're going to have 2.5 to 2.75% interest rates. I mean, a lot of that money on the sidelines is probably going to take some risk. And as a result, I think the demand for that is being pulled forward. People are buying every dip opportunity. And as a result, you're seeing the market gain more momentum. All right, last topic of the day. Palantir gets an upgrade from Piper Sandler to 201 from 182. I think this is the third upgrade on the street for Palantir, getting into that $200 level. Here's what the analysts had to say. There is no argument that Palantir's valuation leaves no margin for error, particularly if any signs of moderating growth emerge. However, We argue that the tremendous visibility on future revenue, over $7 billion of defined contract value, plus an estimated $4 billion of IDIQ contract value, accelerating triple-digit growth in commercial bookings year to date, and an unparalleled wallet share opportunity across $1 trillion of U.S. defense spending, which could allow Palantir to 2 to 3x its current government business and still be 10x smaller than the largest defense primes. Palantir has not reached peak growth. Therefore, we do not see a catalyst to halt current momentum. Essentially, the analyst is saying, look, the valuation is aggressive. We understand the valuation is aggressive. However, it's hard for us to be, upset or scared about the expensiveness if the growth is going to be there. And based on all the analysis they've done around Palantir's government growth, it's likely going to be there. Now, last week, we had some issues with a Reuters article that came out and said that Anduril and Palantir aren't effectively engaging in a way that allows the Army to communicate with other branches of the Army. And there was some issues with how their software and system was set up. I'm going to end out the show today with a clip from Palmer Luckey, founder of Anduril, basically speaking about why that story wasn't a story, but it did create a decent opportunity. And if you took advantage of that, you got into the low 170s Friday, got to the low 170s with the Trump announcement on China, and now the stock's back at 180. Look, at the end of the day, I think the catalysts for Palantir obviously haven't been that expansive because the stock has moved so much, primarily based on earnings growth. So it really doesn't need that massive billion-dollar contract or partnership. They did get $1 billion from the UK the other day for a 5-year partnership with the Ministry of Defense. But I think the valuation is so strong on Palantir from multiple perspective that they just need to keep delivering the growth. And it is really good to see the analysts come out and say, hey, look, things are going good. As long as they keep delivering the growth, we can see the stock continuing to do well. And obviously going into the end of the year, if the stock can continue doing well based on the idea of that accelerating growth, which again, no other software company is growing 40, 50%, then you're likely going to get some more momentum for Palantir. Here is Palmer Luckey basically speaking about why that Reuters article was not necessarily the most accurate in the most Palmer Luckey way. He also said that IPO coming up in a couple of years. So hopefully 2027, we can get some Anduril. And thank everybody for watching another episode of the Daily Recap.
Could you just respond to that reporting, which came from Reuters, and explain the sort of timeline and the inaccuracies that you feel there are in that report?
So you may or may not remember this, but I was a journalism major myself. I was only a semester and a half away from graduating. I was the online editor of the Daily 49er, which was the Cal State Long Beach student-run newspaper. So I care a lot about this stuff, both as a Anduril perspective, and then also just from a journalist perspective. The journalist who wrote that Reuters story would have been failed out of the class by any of my professors. He refused to include our on-the-record statement. He refused to include the on-the-record statement from the Army because they fundamentally made the whole story not a story. There was an analysis saying, hey, there's all of these security problems like the system, the prototype for NGC2, Next Generation Command and Control. It's not tracking what the users are doing. It doesn't have any passwords to log in. There's no security turned on. And they said, oh my God, this is a huge problem. And we said, guys, this was an early prototype. The Army wasn't paying us to demonstrate user accounts. It was paying us to demonstrate integration of different sensors, different weapon systems, all into one pipeline. And Lattice has all this functionality. We do this all the time. It's not like we don't know how to do this. And the Army said the same. They said, yeah, we just turned on all those features. Just a few weeks later, all these issues that you're talking about didn't exist. This was an internal security audit, just noting that these things were a factor in that early prototype. Yes, there's no access control. Yes, that is a risk. Yes, we have not audited all of their security, all their security code. That is a risk. But that's completely normal for early development. But Reuters didn't include our quote, didn't include the Army's quote, because that would have made the entire story irrelevant. So instead they include quotes exclusively from our competitors and from so-called anonymous sources saying that Anduril and Palantir are running this fundamentally insecure thing. 99% chance that was planted by one of our competitors who had access to that memo, and there was only a few people who could have done it. I can make people look bad by slicing and dicing memos too. I'll show you if I want. I'll get back into the journalism game.